Hello and welcome to Bitcoin Dorks, your daily source for cryptocurrency market updates and news. Today we will be discussing an interesting topic that has been on the minds of many cryptocurrency investors lately. What can we learn from the dot-com bubble when it comes to investing in crypto? This question has become more relevant. It experiences a significant growth spurt, with many investors fearing that we may be in the midst of a speculative bubble. But before we delve into the specifics of the dot-com bubble, let's first understand what it was. In the late 1990s, the internet was becoming popular and businesses began to realize its potential for commercial use. As a result, a large number of internet-based companies, known as dot-coms, were launched. Many of these companies had little to no revenue but were still valued at billions of dollars due to hype and speculation. However, this bubble eventually burst, and many of these companies failed, resulting in significant losses for investors. So, what can we learn from this experience when it comes to investing in cryptocurrencies? First and foremost, it is important to recognize that hype and speculation can drive up the value of an asset to unsustainable levels. In the case of the dot-com bubble, investors were so focused on the potential of the internet that they failed to recognize that many of these companies had no viable business model. Lesson 1. Recognize the dangers of hype and speculation. During the dot-com bubble, investors were so focused on the potential of the internet that they failed to recognize that many of these companies had no viable business model. Similarly, in the cryptocurrency market we have seen many projects with little to no real-world utility, and yet their values have skyrocketed due to hype and speculation. To avoid falling into this trap, it is important to do your research and invest in projects with solid fundamentals and a clear roadmap for their development. This includes looking at factors such as the team behind the project, the technology they are using, their use case, and the potential for adoption in the real world. It is also important to avoid getting caught up in the hype and to remain objective when evaluating potential investments. This means not getting overly excited about a project based on rumors or promises, but rather looking at the actual data and performance of the project. Lesson 2. Diversify your portfolio. One of the biggest mistakes made by investors during the dot-com era was putting all of their eggs in one basket by investing heavily in a single sector such as internet-based companies. This lack of diversification made them vulnerable to losses when the bubble burst. In the same way, it is important for cryptocurrency investors to diversify their portfolio across multiple projects and sectors. This can help mitigate the risk of losses if a particular project or sector experiences a downturn. By spreading your investments across different projects, you are less likely to be affected by the failure of a single project. However, it is important to note that diversification does not mean investing in every single project out there. Rather, it means selecting a range of projects that have strong fundamentals and a clear roadmap for their development. Lesson 3. Have a long-term investment strategy. Many investors during the dot-com era were focused on short-term gains and failed to recognize that many of these companies would not be profitable in the long run. Similarly, in the cryptocurrency market it is important to have a long-term investment strategy and to be patient with your investments. Lesson 4. Understand the technology. Another lesson we can learn from the dot-com bubble is the importance of understanding the underlying technology behind a project. During the dot-com era, investors were often more focused on the potential for profits rather than the technology itself, which led to many companies with little to no actual technological innovation being valued at high levels. Similarly, in the cryptocurrency market it is important to have a solid understanding of the technology behind a project before investing in it. This includes and the potential use cases of the project. Lesson 5. Beware of scams and fraud. Investors fell prey to scams and frauds, with companies making false promises and misleading statements in order to attract investments. Unfortunately, the cryptocurrency market is no stranger to scams and frauds either. Therefore, it is important for investors to be vigilant and seeking out independent analysis and reviews of the project. Lesson 6. Don't invest more than you can afford to lose. Finally, perhaps the most important lesson we can learn from the dot-com bubble is the importance of not investing more than you can afford to lose. Many investors during the dot-com era invested heavily in high-risk, high-reward projects without considering the potential downside. Similarly, in the cryptocurrency market, it is important to remember that investing in cryptocurrencies is a high-risk, high-reward, also the risk of significant losses. In conclusion, the dot-com bubble provides us with valuable lessons that can be applied to investing in the cryptocurrency market. By recognizing the dangers of hype and speculation, diversifying our portfolio, having a long-term investment strategy, understanding the technology, being wary of scams and fraud, and not investing more than we can afford to lose, we can increase our chances of success in this exciting and rapidly evolving market. That's it for today's episode of Bitcoin Dorks. We hope you found this information helpful. Don't forget to like, share, and subscribe.